Good afternoon, ladies and gentlemen. Welcome back to the weekly market review. Today is the 13th of January 2025. We just completed the first full trading week of this year. And today I have with me as well Mr. Gerald Wong to share with us some of the market updates. How are you, Gerald, over the rainy weekend?
Very good. I think we have been enjoying this cool weather over the past 3 days. I think likewise, we have also seen some of the cooling in the market over the past week. So I hope to be able to share some of these updates as to why we saw the fall in the US market, particularly last Friday.
Yes, indeed. So we have the latest US job numbers that was published last Friday, and that was unexpectedly strong, and hence inflation may be here to stay for a little bit longer. Interest rate will stay elevated. So good news for the economy may not be good news for the market. So I think Gerald will decipher some of that with us today, and later on I'll do a recap. Over to you, Gerald.
Thank you. Okay, as usual, the sharing today is for information purposes only and should not be taken to be financial advice. We have an upcoming Ask SIAS this Wednesday, 15th of Jan. So if you have got any questions that you'd like to ask myself or Sunny, do sign up for the session. The registration will close tomorrow on the Tuesday, 14th of Jan. If you find our weekly market review helpful, do leave us a review on Google. And if you're wondering how you can join SIAS as a member, if this is something that you would like to do in the new year, you can go to this website, sias.org.sg/membership. And as a SIAS member, you'll be able to access various online resources as well as investor education programs. Okay, so what we saw in the past week would be a fall in the US markets. What we see here is that the S&P 500 was down by about 2%, and we see fairly broad-based losses across tech stocks as reflected by the decline in the Nasdaq, as well as the Dow Jones Industrial Average. Closer to home, the STI performed slightly better. That is because some of the strength in the banks managed to offset the losses in other counters. The key news that came out last week was really the US jobs data. If you were joining our weekly market review in the previous week, that is something that we shared we'll be looking out for. And what we see here is that the jobs data in the month of December was very strong, with more than 250K jobs created, and that is above the market expectations of 150K. Okay, so we see an acceleration from the past 2 months, and the number that came out was also stronger than what investors were expecting. So that reflects the resilience of the US labor market. It reflects the strength in the US economy. And with that, investors are expecting that maybe we won't see as sharp as expected interest rate cuts by the US Federal Reserve. Okay, so the first reaction that we do see is a very sharp bounce in the US bond yields. Okay, so this is the US 10-year government bond yield. We see that it rose to about 4.77% after the US jobs data. This is the highest level over the past 1 year. And in fact, you have to go back to 2023 for it to be higher than the current level. Okay, so it is now above where it was prior to the US Fed interest rate cut, and that is driving the weakness also in the US equity markets. We also see a moderation in the rate cut expectations. So we have an upcoming Fed meeting at the end of this month. The current expectation is that the Fed will keep interest rates unchanged in the meeting, and likewise through to the remaining meetings until June, where it is then expected to make a single 25 basis points interest rate cut. Thereafter, it's expected to stay flat for the rest of the year. So effectively, we might be looking at just one interest rate cut by the US Federal Reserve for the whole of 2025. Okay, so how has that translated to the Singapore market? We see that the banks actually outperformed the STI in the past week, with OCBC recording a 3.2% gain, DBS up by 1.2%, and UOB up by 0.7%. Okay, so the expectation is that if interest rates remain elevated, that will potentially help the bank's net interest margin, and that is helping to drive up the share price of the Singapore banks. Okay, if I were to look at the worst performers, a few property-related stocks here, CapitaLand Investment, Hong Kong Land, and also likewise the REITs. We've got Mapletree Pan Asia Commercial Trust, Mapletree Logistics Trust, due to expectations that if interest rates stay high, then that will potentially impact the sentiment towards these property-related stocks. Okay, so the two stocks that I'll talk about today, the first one is OCBC. Earlier, we shared that it is the top gainer in the STI in the past week. We saw very strong share price performance. And I think until the slight pullback on Friday, it actually reached a 52-week high above $17 per share. So I think many investors have asked about DBS and UOB. OCBC is not a name that we have talked about a lot. So I'll spend some time today to go through OCBC. Okay, so if I were to look at the performance of OCBC's earnings, we also saw growth in the profit in the most recent third quarter results. And with that, we have seen an improvement in the earnings per share as well as the return on equity for the company. Okay, if I were to break it down, what we saw in the third quarter is that while your net interest income was down about 1% year on year compared to the previous year, there was very strong growth in the non-interest income, as well as some of the fee-related income. Okay, so with that, we managed to see an increase in the total income of OCBC. And with that, the net profit was up by 9% compared to the previous year in the third quarter. And overall, for the first 9 months of 2024, it was up by 9% as well. Okay, so I mentioned the net interest margin earlier. So we have seen some moderation in the net interest margin of OCBC over the past few quarters, from 2.29% in the fourth quarter of 2023, moderated to 2.18% in the third quarter of 2024. So with that, we have seen a decline in the net interest income. And the general expectation going to 2025 is that if the Fed were to cut interest rates aggressively, the net interest margin may remain under pressure, and likewise, the net interest income may come down further. Okay, so if the Fed were to slow down the pace of interest rate cuts, then effectively the net interest margin can actually be maintained, and that will also then help to support the net interest income. Okay, on the other hand, we have seen a pickup in the non-interest income. We see here that particularly for the fee income, it rose to about 508 million in the third quarter of 2024, compared to 461 million in the third quarter of 2023. So some of this fee-related income is helping to offset the pressure that we see on the net interest income side. Okay, so we see a breakdown of the fee-related income here. A big part is coming from the growth in the wealth management fee income that reached 245 million in the third quarter of 2024. Once again, a sharp increase compared to the 196 million in the third quarter of 2023. So like what we see for DBS and UOB, the wealth management fee income is helping to boost the growth of the overall fee income of the Singapore banks, which has also helped to offset some of the pressure on the interest income. Okay, so if I were to look at the valuation of OCBC at this point in time, given the sharp increase in its share price, PE ratio of about 10 times, which is above the historical average, price to book ratio about 1.4 times, which is once again above the historical average. Okay, on the other hand, if I were to look at the dividend yield, then that paints a more positive picture. Effectively, current dividend yield of 5.1%, which is above the historical average dividend yield of 4.3%. Okay, the other name that I just wanted to talk about briefly is Suntec REIT, given that it's a REIT that we have received questions on, given the recent corporate developments. So increase in the offer for the units to $1.19 from $1.16 previously. So the point to take note here is that unit holders who have previously accepted the offer may also be entitled to this revised offer price once the offer becomes or is declared unconditional in all respects. Okay, so just a quick look at Suntec REIT's share price. So we have seen the bounce in the share price to about the $1.21 level following the announcement of the offer. For those of you who just want a quick recap around Suntec REIT's underlying performance, what we see here is the breakdown of the income by geography as well as by sector. So Singapore represents about 72% of the income, with contribution from Australia and UK as well. The bulk of it is office, and then we've got some contribution from the retail space as well as convention space. Okay, so what we see for Suntec REIT's third quarter numbers is that the net property income came down. That is because of lower contribution from the convention part of Suntec City, as well as lower contributions from their Australia as well as UK properties. Okay, so with that, we saw a decline in the distributable income as well as the dividend distribution per unit. Part of the decline in the distribution per unit is also because of the completion of the capital distribution that was done in 2023. Okay, if I were to look at the balance sheet of Suntec REIT at this point in time, aggregate leverage ratio of 42.3%. We have seen actually that the all-in financing cost is now at about 4.06% as of the third quarter of 2024, increasing slightly from where it was at about 4.02% in the second quarter of this year. Okay, the adjusted interest coverage ratio at about 1.9 times. So I think overall, in terms of the balance sheet, we see that it is quite close to some of the regulatory limits. Okay, if I were to look at the Suntec REIT valuation on the price to book valuation, currently at about 0.6 times. And if I were to look at the dividend yield of Suntec REIT, currently at about 5%. Okay, so if I were to look at what to look out for in the week ahead, we have the US Consumer Price Index data that's coming out this Wednesday, 15th of Jan. So another key data point that will then allow us to assess what the US Federal Reserve is going to be doing next. We also have an upcoming 6-month T-bill auction on the 16th of Jan. So for those investors who are interested in the T-bill, that might be something to keep a lookout for. Okay, so with that, I'll hand over to Sunny, who will share with us the technical analysis.
Okay, thanks, Gerald, for the updates on the Singapore markets and the updates of what is happening on Suntec REIT over there. I will do a recap of what happened on the STI, the Singapore market first. So we saw that the STI actually hit a new 17-year high over here on Wednesday, and this was the first sign that the US economy was doing well, because on Wednesday we saw that ISM service PMI data, which was also above market and analyst expectations. So that's why once we see that the US economy is performing well, there's the risk that the inflation may be very sticky and interest rate will remain elevated, and the STI being more than half of it is covered by the STI covered by the banks. We also saw a jump on Wednesday. Hence, you can see that the high now at 3886, 3887. That is the new 17-year high that we are looking at. And the all-time high, we are still looking at the 3,906 points, which was in a 2007. Then after that, we have that pullback on Thursday and Friday, and a slight pullback today as well. So this is the worry that interest rate is going to stay high, and then the global markets, you can see that this morning, 13 January, Hang Seng Index pulling back about 1.5%. Last Friday, all the US indices pulling back by more than 1.5% as well. So that is why the global markets are being pressured right now, because they are afraid that interest rates might be staying high for the whole of 2025. And I believe likely we could only see the first rate cut happening in this possibly happening only in the second half of this year, and the first half likely we will be unlikely to see any rate cuts. And Gerald touched on the CPI data that's coming out this Wednesday that will give us the latest update on where the inflation numbers are. If we get a higher number, that means the inflation might be flaring up again. That will be an issue and cause market to pull back even further. Okay, so after STI reached the new 17-year high on Wednesday, we had a pullback. The 20 days moving average was the first support level, which is the Bollinger Band basis, now at 3796, or the 3800 was the pivot level on the Bollinger Band and the 20 days moving average. Below that level, the next support level, if you look at the exponential moving average of 50 days, that's the blue line right here. That's at 3749 or 3750. That is the next support level, followed by the lower bound of the Bollinger Band at 3722. So if the STI pull back to these two levels, 750 and below, that is a good sign to accumulate on the STI index, given that the interest rate, US Fed interest rate is likely going to remain high, and then banks are likely going to benefit from the higher net interest margin or net interest income that could provide a catalyst for the STI to really go and retest the all-time high of 3906. Okay, so these are the support levels that I'm looking at for the STI index. But currently, the momentum reading on the indicators, you can see that MACD is slightly negative now. The crossover of the MACD line below the signal line has already occurred today on Monday. So that means that we are going into a downtrend. Okay, so downtrend, you look for the next two support level at least the 3750 level, which is the exponential moving average. 50 days exponential moving average with the blue line right here. On the RSI, we have also just breached below the 50-point neutral mark, now reading at 49. So that means that momentum is going to be very weak right now. Okay, for this week at least, because this is the latest momentum reading that we get from the indicators. So STI is likely going to pull back slightly furthermore, and then 3750 is the first support that we're looking at for any bounce to happen on the STI index. Okay, next, let's move back to the US indices. You can see that US index, the Dow Jones index, has pulled back already quite a bit since the month of December and last Friday. You can see we got quite a big drop of 1.63% on the Dow Jones index. That has also breached the 100 days exponential moving average, which is the amber line that you see here. And the next support level will come in at the lower bound of the Bollinger Band at 41,770 points, followed by the 200 days exponential moving average at 41,156 points. Okay, so the MACD is looking very negative right now, although we do see some kind of subsiding of the downtrend in the last 2 weeks at least. But then you can see that the Friday pullback actually sort of reignite that downtrend again, or the downtrend momentum again on the MACD indicator. That is also what is indicating on the trajectory of the MACD line diverging away from the signal line again. So at this moment, there is no sign of a convergence of the MACD line towards the signal line. Hence, we may see further downwards pressure towards towards the CPI data this week. Okay, and the RSI is reading at 33 points right now, very weak reading, quite a bit below the 50-point neutral mark. And until we reach the 30-point level, that is where the oversold level is, only then we can see some kind of rebound happening. And that is also what happened during the mid of December as well, where the RSI hit the 30-point oversold level and then rebounded up. Okay, so expect a slightly more of a bit of a pullback on the Dow Jones index, at least for today, tonight, and tomorrow, before the CPI data starts to change, may start to change things again. So the Dow Jones Index is expected to test the lower bound of the Bollinger Band at 41,770 points. Next, let's move to the broader index, S&P 500. It actually pulled back 1.54% last Friday. And you can see that we have actually tested this level of 5,832 points on two occasions, on the 2nd of January and on the 20th of December. So this could be a very strong support level. The 5,800 level could be a very strong support level that we are looking at right now. You can see that after last Friday, where it tested the 100 days exponential moving average, which is the amber line at 5,815 points, you can see that the candlestick starts to move up again, and hence you sort of have a like a candle hammer formation, and that could be an indication that, hey, this is the support level that we will be holding out for a rebound on the S&P 500. Okay, if let's say we're going to breach this level, then it will going to be a very big drop of 5,580 points. But at this moment, the 200 days exponential moving average seems unlikely to be tested for now. Okay, the MACD indicator very negative, so exacerbated by last Friday pullback. So we are likely going to see S&P 500 test the 5,800 point level for some times before we have a reversal. On the RSI, we are reading at 39, 10 points below the 50-point neutral mark. The previous time we were at this level, somewhere in December. We also have a rebound to retest the yellow line that you see here, which is the RSI 14 days moving average. So right now, the 14 days moving average is reading at 46. So even if we have a rebound, that is the first level that we are looking to see some kind of resistance forming up. So I believe S&P 500 will consolidate around the 5,800 points level for some time before market starts to see some kind of rebound again when we get some kind of indication from the indicators that a rebound is likely to happen. Lastly, let's move to the tech-heavy Nasdaq Composite Index. So we have pulled back all the way. We have tested the lower bound of the Bollinger Band on the Nasdaq Composite Index, which is the 19,083 points level. And then after that, we closed back up above, or not really above, but slightly below the 50 days exponential moving average, which is the blue line. And that is around the 19,281 points level. Okay, so we have not really challenged the 100 days exponential moving average, but that is a possibility given that this was also previously a sort of a resistance point in a November period, late October, early November period. So this could have a change in polarity to become a support level, and the 100 days exponential moving average will catch up. And let's say we pull back to this level, this could be a good level at 18,785 points. This could be a good level to get in on the Nasdaq Composite Index. Else, the lower bound of the Bollinger Band now is still holding the Nasdaq Index up at 19,000 handle. Okay, so the MACD indicator for the Nasdaq Composite Index among the three US indices, I would say is the most negative, because you can see that the gap between the MACD line and the signal line is the greatest. That is also signified by the MACD histogram. So that big gap over here shows that there's a lot of negative momentum right now in the Nasdaq Composite Index, with the background that interest rate is going to remain high. So the growth stocks, the tech stocks in the Nasdaq Composite Index are likely to be impacted the most. So the RSI reading at 43 has also breached the 50-point neutral mark. Hence, it is on a downwards trajectory. But the previous time that we saw the RSI rebound was somewhere around here, the September period, where we see that the RSI hit a low of 37 points. Okay, so until the RSI hit below the 40-point level, I don't think we are likely to see any kind of a rebound on the Nasdaq Composite Index. So we still have a few more days, and I don't think the market is likely going to move very much until Wednesday's CPI data. So do look out for that. That one will help us to have a latest reading on where the inflation numbers are. I hope inflation numbers are not too bad, and then those support levels that we identified earlier could have a rebound coming on Wednesday and Thursday. Okay, so these are all the updates that I have for this week, a weekly market review. Anything to add on before we share with you that next week we have a special guest?
Yes, I think really the key is watching the inflation data that's coming out this week. Given the very strong jobs data earlier, I think that is definitely something that many investors are keeping a lookout for, to see whether the US bond yields go up further. and how that will then potentially affect the stock market.
Yes, and if you have any questions, this Wednesday, 15th of January, is our SIAS session. So you can join us as a member and then join our SIAS webinar to ask us any investment questions that you have. And next Wednesday on the weekly market review, we have a special guest. We have the market strategist from Mumu, Isaac, to share with us the Mumu market outlook for this year. And then we will also have a short discussion with him to ask him some questions on what to look out for, what kind of trend, what kind of sectors we should be looking at for 2025 as well. So do stay tuned to our next week weekly market review. Okay. So
It's
I think
on
that's
Monday, not on Wednesday.
yeah, it's on Monday. The weekly market review is on Monday, next Monday, 20th January, and the ASIAS is this Wednesday, 15th January. Okay. Okay, I think that is all the time that we have for today. So in the meantime, do trade safe and stay safe, and we will look forward to seeing you again on Wednesday and next Monday. Have a good trading week, everyone, and goodbye.
Thank you.